Hi, Carl and Mary. It's very nice to see both of you today. I'm excited to go over this comprehensive financial plan that I've prepared for both of you based on the information that you've previously provided. Before we get into the presentation, I want to go over our agenda. Initially, I want to go over your overall family profile with you. After that, I want to go over some initial recommendations. And then after, we'll get into these general recommendations in more depth and talk about them in specifics. And then I want to summarize everything that we've discussed. I have some supplemental data in the back for you, nothing we need to go over. However, it is there for your reference later on if you're reviewing this information at home. And then I want to give you all the time you need to ask me any questions you have, share any comments or concerns, or just general feedback. Overall, Carl, you're 32, Mary, you're 29. You're married filing jointly. You currently do not have any kids, though you do plan to have 2 in the near future. You don't have any other family members living with you at this time. However, Carl, your grandparents are not in great health right now, and there is the possibility that you could become responsible for caring for them later on. Your net worth is right around $70,000. And Carl, you're making about $40,000 a year, but you are a 25% owner of indoor blinds. And Mary, your salary is about $65,000 a year, along with a pension that you'll receive from your job worth 70% of your final year's salary. Looking at your overall life cycle, this puts you into what we call the asset accumulation phase, which is for people in their 20s to mid-50s. Looking at your overall life cycle, your current risks include an untimely death or disability, any sort of event that could result in a financial loss, such as being sued, or indoor blinds, again, is a large asset of yours, so that puts you at risk for a financial loss. Any unemployment, whether it comes from indoor blinds or married from your job. Any health problems, either for you or future children you may have. And any loss from investment assets, like we've discussed, such as indoor blinds. Your general goals are education funding, risk management, estate planning, and financial security. Carl and Mary, you both filled out a questionnaire for me ranking your top 10 priorities. Now, while you didn't both agree on all the priorities in an exact order, you did agree on your top 4 priorities. So it's good that you were both on the same page. Now, your top 4 priorities agreed on by both of you are proper insurance protection, adequate funding for college for any future children of yours, retirement funding, and business succession planning for indoor blinds. Now, while priorities are general and will probably not change significantly over time, goals are more specific and will change as time goes on and as your life cycle changes. Now, you shared some good specific goals with me early on when we met. Out of those goals, some of your short-term goals were purchasing a new truck, right around $36,000. You wanted an in-depth review of all of your insurance coverage. You wanted your investments reviewed, and you wanted to get some estate planning in place. And for your long-term goals, education funding for college for, we are assuming, 2 children in the future, as well as retirement planning to retire by Carl's age 62. Now, before we go into any of the recommendations, I wanted to review the assumptions that I've used in preparing all of my recommendations and my projections. Some of these were provided by you specifically, and some of these are just general economic assumptions that we are projecting out for the future. Now, some of these specific assumptions include your current salary and expected pay increases, including a 5% annual salary increase for Carl and a 4% annual increase for Mary, along with some economic assumptions like general inflation at 3% each year, education inflation at 5% a year, and current mortgage rates of 5.25% each year. Initially, I want to review recommendations in what we call a 3-panel approach. And I like the 3-panel approach because it breaks down everything that we're going to review in 3 segments: risk management, short-term goals, and long-term goals. Now, as you'll see here, I've prepared a slide summarizing all of your current insurance information. Now, based on this review of your insurance policies, I would recommend that you increase your life insurance coverage, that Carl input a disability policy, make some changes to your auto policies, and that you get a personal liability umbrella policy. Now, looking at your financial short-term goals and your current positions, I would recommend that you increase cash on hand for any emergencies and that you reduce your debt to total assets ratio. Reviewing your long-term financial goals, I recommend that you increase your overall savings rate in order to help you achieve some of your additional financial goals, and that you get your estate planning documents executed. Now, one of the goals we've already mentioned a couple times has been education funding for 2 children. So what I've assumed is that you would have one child in the near future that would be starting college in 18 years, and then another child 2 years later that would be starting college in 20 years. And based on that assumption, and assuming that your children will be going to a university that has average cost tuition, you would need to set aside $4,000 a year for your first child and roughly $3,600 a year for your second child each year until they start school. And what you'll see on this slide is what their education accounts would look like from the time they started college till the time they finished college. Now, moving on to your legacy and estate planning review. Right now, you currently do not have any documents in place, so I strongly recommend that you get some general estate planning documents in place, including a last will and testament, an advanced medical directive, and a power of attorney for healthcare, along with a power of attorney for financial matters. Now, you've indicated to me that you want a simple estate plan, and based on current estate tax laws, it does not look like you will have any estate taxes. So I think that just a simple will be your best option, will help you achieve your goals, and I don't recommend any additional trust or any other complex estate planning at this time. And then, in addition to these testamentary documents, Carl, I think it's important that Indoor Blinds puts together an operating agreement and a buy-sell agreement. And before I can provide any more specific recommendations on that, I would love to sit down with you and your 3 partners and get to know the 4 of you better and what you hope to get out of this company, and help you come up with a plan that will protect everyone and help everyone achieve your joint goals. Now, getting back to the risk management portion, what I've done here is I've reviewed all of your insurance coverage in detail and provided any recommendations on changes. First off is your health insurance, which is currently provided by Mary's employer. And currently you have the option to change to a plan that offers an HSA. And as you can see here, I've done some calculations, but overall I think it would be beneficial to change to a plan that offers an HSA due to some tax benefits offered through the HSA, along with some matching provided by Mary's employer. As I previously mentioned, I recommend that you both increase your life insurance. Carl, I think the best policy for you at this time would be a $500,000 policy that would be a 20-year term costing about $420 a year. Mary, even though you have some employer-provided life insurance, I would still recommend that you get a $500,000 additional term policy at this time with a premium of about $400 a year. Now, currently, looking at your long-term disability, Mary, you have some disability insurance provided by your employer, so that's good, and I would not recommend making any changes to that. Carl, you do not currently have any long-term disability in place. Due to the fact that you're self-employed and a partner of a company, I think it's very important that you get some disability insurance in place, and I've outlined here the policy that I recommend you getting. It would sort of mirror Mary's policy. That would be a 60% of your self-employment income. Looking at your property insurance, I wouldn't recommend making any changes at this point based on the quotes that you have provided. You currently do not have a personal liability umbrella policy in place. I recommend getting $1 million policy with an annual premium of about $200. Once this policy is in place, it will be imperative that you make sure that your underlying coverage amounts meet the minimums required by this policy. Carl, you stated that you want to get a new truck, but until you get a new truck, at this point, you could reduce your overall insurance coverage to get rid of collision and comprehensive and reduce your annual premium to about $500 a year. Of course, if you do get a new truck in the near future, this will need to be reviewed, but at this time, this is the policy that I recommend. Mary, looking at your policy, it looks like you can reduce your premium from $1,400 a year to $1,350 a year without sacrificing coverage. And looking over your savings and investments, currently you don't have a large diversified investment portfolio. Mainly you have Mary's 401k and then of course, Carl, your indoor blinds. Right now, Mary, you're contributing 3% of your salary, and this totals to about $3,900 a year, including your employer match. In addition, while you're not having to pay for this out of your cash flow, you do have a strong pension that will be worth 70% of your final year's salary, which we have assumed a 3% cost of living adjustment annually. Now, looking over the financial information you have provided, I've compared your current situation versus some general benchmarks just to give us a good idea about where you're at and where you should be for some financial strength. Overall, looking at your liquidity ratios, you do need to increase your emergency fund. Looking at your debt ratios, while your housing ratio is not an issue, I'll discuss later, you do have the ability to reduce it even further. Looking at your ratios for financial security, it looks like your savings rate is lower than recommended. However, I do want to keep in mind the fact that Mary does have a pension that will be worth 70% of final year's salary. Overall, it looks like some of your discretionary cash flow should go to savings and debt reduction and less to discretionary spending. Looking at your performance ratios, again, it looks like your performance is not an issue. However, I do want to keep in mind that, Mary, your 401k has only been invested for 1 year. So it's important that this gets looked at on a regular basis. Looking at your overall statement of income and expenses and comparing them to general benchmarks, your biggest area for improvement would be reducing your living expenses down to a more appropriate level, as well as reducing your overall debt payments. In order to reduce your living expenses, I would decrease entertainment spending, which I'll discuss in further detail, and I would also get some of your debt paid off as well as refinancing your primary mortgage. Looking at your current balance sheet, looks like your personal use assets are a larger percentage of your overall assets than would be recommended, and that your long-term liabilities are a larger percentage of your overall liabilities versus your net worth than what would be recommended. Overall, after this review of your financial position, strengths and weaknesses, your insurance expenses are low, you have assets with a high ability to appreciate, specifically indoor blinds, and while your debt payments are higher than would be recommended, your car loan and your credit card will be paid off in just a few years. And then, Mary, you have a pension benefit, which is a very good strength as it reduces your need for current savings. Looking at your weaknesses, as we've mentioned, your debt payments are too high, as well as your living expenses. Your overall cash flow as it stands currently is negative. And one of your largest asset, indoor blinds, is something that could be hard to liquidate if you ever needed to get some cash on hand. Now, based on this review, the specific recommendations that I have are refinancing your existing mortgage to take advantage of lower rates, which would increase your cash flow by $3,765 each year. I would decrease your entertainment spending to about $500 a month, and I would defer the purchase of the new truck for a couple of years until the credit card debt and your current car loan are paid off. Right now, your debt ratios are too high, and based on the repayment of your current liabilities, you'll be able to stay within proper ratios if you defer this purchase for a short time period. What I've provided here is a summary of, based on these recommendations, what your cash flow would look like in about 3 years. And as you can see, this would get your current ratios, or your liquidity and debt ratios, into a much better position. It would have your income and expenses to a much greater net discretionary cash flow position, which would allow you to start saving for education, as well as providing the cash flow for a new car. And it would have your balance sheet looking significantly better, and would have allowed you to have more cash on hand and a more diversified financial position. At this point, I want to review your retirement funding schedule. What I've done here is a series of calculations showing, based on Mary's pension and your Social Security and Mary's 401k contributions, what your retirement projections look like throughout your life expectancy. For presentation's sake, I didn't include every single year on this slide. However, I did include current year, retirement year, then the years from Carl's age 80 to Mary's age 85. So that's what we've used for your life expectancy. And due to Mary's pension and your Social Security and your reasonable retirement needs, it does not look like you will have any sort of problem funding your retirement, even if you do not liquidate indoor blinds. What I have prepared on this slide is the first 5 months and the last 5 months of the amortization schedule for the new mortgage that I recommend. Again, as we previously discussed, this would save you over $3,000 a year. This is a summary of Mary's car loan and when it will be paid off. Again, I've only included selected months for the sake of presentation. However, right now you're in month 24 and it will be paid off in month 60. What I've provided here, again, are select months for your credit card to show you when it will be paid off and how much of each payment is going towards interest and how much is going towards principal. To recap the recommendations I've made, for your risk coverages, I recommend you each obtain a new life insurance policy. Carl implements a disability policy, and that you get a personal liability umbrella policy, and that you change your existing property policies to decrease premiums while maintaining adequate coverage. For your savings and investments, I recommend some specific changes in your entertainment budget and debt payoff in order to provide cash flow to achieve your other goals, such as a new car, funding for children's education, and certainly an emergency fund. For your legacy documents, I recommend that you implement a complete set of estate planning documents, including some succession planning documents for indoor blinds. Additionally, I just wanted to review a little bit of information that I'll still need in order to confirm my recommendations. While you provided some tax information, I would still like copies of the past 3 years of your tax returns and any tax returns that may have been filed for indoor blinds. Mary, I would like for you to check on your pension and get me some more details on that, including any required service years and any survivor benefits. I would like you two to sit down and discuss any capital retention goals you have for legacy planning. By that I mean, is there a specific number you wish to leave behind to your children? I would also like a copy of your real estate deed. On these next few slides, this is just some information that you have previously provided or that was included in this presentation. I don't want to go over in any detail, but do want you to feel free to look through this, and please review it and let me know of any questions or any changes you wish to make to any of this information. This is the economic factors that I've used in this presentation. This is simply a copy of the engagement letter that you provided at the inception of our arrangement. This is a copy of the risk tolerance questionnaire that you provided, which guided me in preparing your investment recommendations. This is a copy of your investment policy statement, which affirms previous recommendations that I made. Carl and Mary, again, thank you for your time, and I hope that this information has been helpful, and I look forward to hearing your questions and your feedback. Thank you.